Now then, by the time 2016 was over, Kenyan bank stocks had been severely mauled, and that's putting it mildly. Standard Chartered came out with the least damage. Its share prices ended the year down by less than 7%. But share prices in the rest of the listed banks had fallen by anywhere between 10% and 56% in 2016, and there was more pain to come. September 2016's Banking Amendment Act, which imposed some pretty hard caps on lending and deposit rates, complicated matters for banks by compressing their margins. Earlier on, I asked Mbithe Muema, an investment analyst with Africa Alliance, if bank shares in Kenya have further to fall in 2017.
Speaking about the counters, you must recall that there was the interest rate cap that was introduced in August. What that meant is that any investor who was looking at the banking stocks actually imagined that anybody with retail exposure would get a huge hit in terms of the operational setup. And thus you had the equity banks, the KCB, the cooperative banks taking a larger hit compared to Standard Chartered, whose business is largely institutional and wholesale.
Right, but a lot of these things, if you break down that performance and look at what happened over the last 3 months, it doesn't look like they actually got hit that much. Actually saw some counters gaining.
They did.
In the last quarter of the year, which would seem to be antithetical to the idea that, look, your retail operations are getting hit and your margins are being hit as well, so why would shares appreciate?
I think when the cap came out, it came out overnight and nobody knew what it actually meant. I mean, you recall that the KBA was engaging with the banks, with the central bank, with the government to see how they'd actually operated. So in the midst of that confusion, everybody just panicked and said, you know what, I'm exiting Kenya. And you must remember that now our exchange is actually 70% foreign driven. So sitting on our desk would get people who was like, I don't care what's happening, just sell. So it started hitting the 10% limit. So one day it's 10% down, the next day it's 10% down, the third day it's 10% down.
So basically we panicked and oversold. Right, but stepping back away from what the share prices do tell us, I mean, just on a pure balance sheet basis, I mean, a lot of these tier 2 and tier 3 banks, most of which are not listed, are essentially sitting ducks, either for takeovers or consolidation, aren't they?
They certainly are, but it depends. You see what has happened because of the 14% cap. Before that, the second and the third tier banks would literally go and get money from the larger banks. And then they'd on-sell that money to retailers or SME or micro SME. So they'd probably get it at 14%, give or take, and then on-lend it at anything above 25%. So that's literally how their businesses are operating. Now, this has literally changed their businesses, and they can't afford to actually be getting cheaper money because now your larger banks will say, why should I take the risk and give you the money at 14%? I can give it to the government, I can give it to my normal customers, because the playing field has literally been evened. Are they ripe for consolidation? Everybody has been talking about consolidation for the last 10 years or so. We are certainly overbanked. But if you actually look at the genesis of some of the banks, some of them came up because of tribal decisions, because of private family decisions. So the setup actually does not mean that you can get Bank 1 and Bank 2 to consolidate in terms of their operations, in terms of any synergies that will come off that. I think what it means is for any new players that are coming into the market, there's an opportunity to look for families that are willing to sell their stakes in this in the banks. Take the case of Standard Bank Mauritius. When it came into Kenya, it actually ended up paying $10 million for a bank. Yet if they were to go directly to the CBK governor, he would not talk to them if they didn't have a $50 million check to buy the bank. So it's not an opportunity for consolidation. I would actually think it's more of an opportunity for takeovers and mergers, and especially more opportunistic for companies that are coming from outside of Kenya.
So who's most vulnerable right now? We're essentially acting like the vultures here, but who's vulnerable for a takeover?
I'd say the third tiers are not in a very good position now. Some of the second tiers, in terms of the listed, not necessarily, because they do have sufficient capital to keep going. I think it's just a matter of seeing how differently they can begin to operate now. And everybody now is driving a transactional strategy. How much money can I get? There's the conversations that are ongoing about the kits. When that goes online, then everybody can literally easily run a transactional revenue base, as opposed to on lending, as you figure out what's going to happen over the next year or the next 2 years.
Quite a few job losses also essentially in the pipeline. You saw National Bank waking up, I think it was towards the end of last year, and then saying, look guys, we're going to put a voluntary retirement program in place. If you're interested, please apply. How much worse can it get in terms of just job losses in the bank sector?
I wouldn't have a number, but what I'll say, it's certainly going to be very painful. And Because your banks will have to be very efficient. They'll have to start operating at cost-to-income ratios of less than 50%. If I'm going to run a transactional revenue strategy, for example, it means I can no longer be able to afford to have you serving customers who are not coming to the banks. And I think even as you go on in your conversation, you look at the banking sector, the growth in terms of credit growth has not been that high. And I don't think we're going to actually end up seeing double-digit growth for another year or two.